What we want to do today is start talking about banks. What we talked about the last couple of classes with this asymmetric information idea was why banks exist. What role do they play in the economy that nobody else really is? And the answer is they're dealing with asymmetric information in the case of loans. The other thing they did, if you'll recall, is to reduce transactions costs for both savers and borrowers. But anyway, so there's this function performed by banks. What is the nature of banking? If we think about the bank, and by the way, we could draw a similar picture for all financial institutions, but banks bring in deposits and then they make loans. Now, this is what they specialize in, and really in terms of a specialty, their specialization is demand deposits. That is to say, bankers have traditionally done this and done it more than other financial institutions. And this is just what they're best known for. Those of us with checking accounts are typically doing business with a commercial bank. And then, although they make loans and really make other types of investments as well, is the commercial loan that are their specialty. Loans to businesses, and that's what we mean by commercial loan. Okay. Now, there are other places that banks bring dollars in, or other ways they bring those dollars in, and they send those dollars out for other things, but that's their specialty. Demand deposits in, commercial loans out. And we're going to talk more about this really in the next chapter of material. Okay. But anyway, every financial institution, we could draw a box here, and we could show the financial institutions bringing dollars in and sending dollars out. But for each financial institution, the specialty is a little bit different. If we put savings and loans up here, their specialty is bringing in savings deposits. And their specialty is sending out loans for homes, so mortgages. If we talked about credit unions, their specialty is bringing in savings deposits and making personal loans. Okay, and it's the same thing for every type of financial institution. There's some little picture that we could draw, and really, once you can draw that picture, then you kind of think, boy, I can think my way through this problem here. You know, it's like I know what that institution does. But and I'll put the term up here, every one of these financial institutions goes under this general heading of financial intermediary. And the idea of the financial intermediary, middleman, there's somebody over here with those dollars, those deposits, and there's somebody over here that needs those funds. In the previous chapter, previous unit material, we talked about savers and borrowers or investors. Okay, so basically, financial intermediary, they always perform a function of this nature. Is they specialize in bringing dollars in one way and specialize in how they put those dollars to use. Okay, so anyway, well, let's go on. I don't want to belabor that too much. If we go back to the history of the United States, and we're going to talk a little bit later about the history of banking in the United States, but if we go back to the history of banking in the United States, you go back to the period, 1776 going forward, and the very first banks in the United States were basically specializing in, we didn't have demand deposits at that point. What would happen is somebody come in and give gold or silver or foreign currencies or whatever to a bank, and the bank would hand them not a checkbook, but the bank would hand them currency that bank issued. And so it was a piece of paper that you could spend, which is more or less what a checking account is. And then those banks would specialize in making business loans. So this has been the story of banking in the United States. When we use this term bank or banking, the official term, and here's the word that gives rise to this, the official term is these are commercial banks. Okay? Their specialty is making commercial loans or business loans. Sometimes we'll hear these referred to as business loans And sometimes you'll hear these referred to C&I loans, C&I commercial and industrial loans. But it always boils down to this same thing. This is their specialty. Now, how do banks earn a profit? And by the way, let me just say before I get into this, banks are private companies. You can own a bank, I can own a bank. Pretty much anybody in theory could own a bank. You cannot be a convicted felon. And that would not be smart to give a bank charter to gather deposits up and give those away to, convicted felons. They would love that. Anyway, the felons would love it. We depositors wouldn't. But, so what we have is a private company, a bank. It's owned by private investors, not by the government. In many other countries, governments do own banks. And that has been a problem for those other countries. What happens is when the bank is owned by government, then what happens is the people that run the bank tend to get their orders from politicians. And very often they make loans that are not going to be paid back, but they make those loans because it's politically popular. There's pressure to do that. But anyway, I don't want to go down that path very far. Anyway, the point is we've got these businesses and they're organized to earn a profit. That's what the shareholders want. Okay. Now the question is, how do they earn a profit? Here's the first way, and the term I always use is they play the yield curve. And let me just draw a little graph here to illustrate what I mean by that. Not very long ago, we were talking about yield curves. And we were saying those yield curves normally have this positive slope to them. Okay? Well, here's what bankers do. They take in deposits, and I just talked about this a moment ago where bankers are taking in deposits. Bankers take in deposits that tend to be shorter term. Checking deposits have no maturity, right? You can put money into a checking account and go right out and write a check that day. So bankers take in shorter term deposits, and then what they do is they make loans that have a longer maturity. And so if the risk were exactly the same, and I'm not saying it is, but if the risk were exactly the same, then due to the fact that the yield curve's got a positive slope means that bankers would be basically paying a low interest rate to depositors and then charging a higher interest rate from lenders simply because the lender has used of those funds for a longer period of time. Okay, and so banks are basically just taking the money in short term, saying, hey, that's a short-term deposit. Here's a little bit of interest. They're lending the money out longer term and saying, boy, this is for quite a while. We're going to charge you a higher interest rate. There's more to the story than that, but that is an essential part of what's taking place. Now, I won't spend too long with this, but you may want to think about this for a second. Hey, how could a banker take it, and there are more than just demand deposits or checking, there's savings deposits, but how could a bank take in a short-term deposit, let's say it's a 1-month deposit, and then turn around and make a loan that's maybe for 5 years, which would be 60 months. Could you take in a 1-month deposit from somebody and then loan that out to somebody for 60 months? Would you be comfortable doing that? Because that money's gone. You know, like if you lend money to somebody to buy a car, they say, okay, I'm going to go buy a car. They buy that. At the end of the month, this depositor says, I want my money back. Then what do? You go to the car buyer and go, hey, could I have that money back? No. So here's what the bank does, the banker. The banker will take your deposit and lend it to somebody for 5 years. By the way, 30 years too. But they'll lend that money to somebody for 5 years, 60 months. And then here's what the banker is counting on. When you come back in and you want your money in 1 month, the banker is going to get somebody else to give them a 1-month deposit or a 2-month deposit or whatever, but they're going to get a deposit from somebody else. And when you want your money back, they're going to give you the other depositor's money. And then after another 1 or 2 or 3 months or whatever it would be, this next depositor comes in and says, I want my money back. The banker says, okay. And he's counting on getting another deposit from somebody else and paying that second depositor back. And so basically, if we just think of these as 1 month deposits each time, the banker's thinking, I'm going to get 60 people in a row to come in here and let me have their money. And I'm going to basically use this series of 60 1-month deposits to fund or to finance a 60-month loan. A home loan's 360 months. I'll do it 360 times in a row. And by the way, that's not the end of it. You may deposit $1,000 in the bank, and the banker may lend out $20,000 to somebody to buy a car. And so it's not just a case of, I'll do this 60 times, but I'll also do it 60 times 20. I need $20,000 to lend out, not $1,000. And so partly the banker is being paid for basically playing the yield curve, but partly what the banker is being paid for doing is serving as a place to gather up these deposits to make these loans. By the way, this is exactly what we talked about at the end of that last unit. I said, oh, why do bankers exist? To deal with asymmetric information. And then at the end, I said, to lower transactions costs. Well, here's the transaction cost, and that's what I'm describing right now. If you wanted to buy a car 60 months, and there were people out here with some money to lend to you, the transactions costs would be very high of finding 20 people to give you $1,000, and then paying each one of those 20 people back at the end of the month and borrowing from another 20 people at the end of that month and so forth. The banker is lowering your transaction costs by a lot. And so the banker is doing that. Okay? Okay. And I'll just write that down, lower transaction cost. People come to the bank because the banker lowers transaction costs. Okay? A third thing, which we already talked about, is they deal with asymmetric information. And by that, another way of describing this is they are specialists at making loans. Not only making the loan, but getting the loan repaid. Right? They collect information, they screen, they require collateral. After the loan is made, they monitor these payments coming in, make sure that any agreements that are in the loan are adhered to. They seize collateral if the loan's not paid off and so forth. Okay? They price that credit risk appropriately. The other thing they do, and this is not dominant yet, but it's of increasing importance, is they earn money from their off-balance sheet activities. Which, another way of saying that's just services. These things that I was talking about before, bringing in deposits and making loans, those go on the bank's balance sheet. The deposit's a liability, the loan is an asset on the bank's balance sheet. But other things happen where banks just charge a fee. And some of these you know about, and this is an old one, but safe deposit boxes. If you go to a bank and say, hey, do you have a safe deposit box? They say yes. And so then they would take you into a room, all these metal boxes there. They charge you, I don't know, $30 a year, whatever, depends on the size of the box. They charge you $30 a year, you pay a fee. Whatever you put in that box does not go into their balance sheet, it's yours. They are just charging you for safekeeping. Okay, well anyway, that's an old service that banks have offered for a long time, but what they're doing is, as time goes by, finding more and more services that they can sell to the public and then charge a fee for that. And so these off-balance sheet activities are of growing importance. Other things they do would be like charge for checks that you might bounce and things like that. These would be off-balance sheet activities. Okay, any questions about this before we go on? Yes, sir.
How hard would a bank try if they knew you were putting cash in your safe deposit box? Would they try to get you to deposit that?
Well, how hard, if they knew you were putting cash in your safe deposit box, how hard would they try to get you to deposit? Bankers always want you to make a deposit, whether it's in your safe deposit box or wherever it is. So that's the constant. They do not know what you're putting in your safe deposit box because that's a secret. You go in that little room and there's nobody going, boy, you sure have a lot of cash. You want to make a deposit? They just don't do that. So,
Can't they look then?
no, they can't look.
They can't?
It's a secret. You know what I mean? I keep comic books and stuff in mine. Then I go in during the lunch hour with a sandwich. I sit down. I get the comic books out. I get the sandwich out. Sit in that little room. Anyway, no, they simply don't know what's in there. If you would die, then there will be somebody go in, not the bank, but anyway, some bank officer will go in there with a key, and if they've got a key and you're, whoever's managing your trust or whatever, they'll have your key, and then the banker will open it and they'll back off, so they don't find out even after you die. Okay, and we're assuming that the bank complies with the law. There could surely be some dishonest banker that would know, but that would be the, one in a million cases. But they just don't know.
Okay, I thought they could look at it.
But while you come in, they may say, hey, are you interested in hearing about our super duper savings account for people with red hair or, or whatever? And then because they have got some way of attracting depositors, and I mean, they are always thinking about what that is. And so no doubt they'll use that as an opportunity to market something to you. Yes, sir?
That first question on my quiz today, it was talking about asymmetric information.
Yeah, huh?
How the borrowers were going to take advantage of or what was the answer to that question? How does it relate with number 3?
What I'm saying is this, is that if there are no banks, and then each one of us as savers are trying to lend money and earn some interest, then in that setting, borrowers will take that money from you and not pay it back. And that is what creates the role for banks, and that is what they specialize in, is preventing that. They collect a lot of information, they analyze that information, they require collateral and so forth. So they know how to deal with that information better than we as individuals do. Okay? Anyway, so this is a general story of what banks are up to. They're bringing in deposits, they're making loans. And they're doing these types of things here to earn a profit. Okay, now that leaves a pretty wide scope, a pretty wide range for bank operations. There are about 7,000, 7,500 banks in the United States. These are commercial banks in USA. The number's been declining over the years, and so probably closer to 7,000 to 7,500. But anyway, someplace in that range. There are, in addition to that, there are other institutions that are not commercial banks, but they take in deposits and they make loans of various types. And so some people that are discussing banking, they will lump these other institutions like savings and loans in with banks and credit unions and so forth. And I'm not doing that. So when I say there are 7,000, 7,500 banks, I mean commercial banks that specialize in demand deposits, commercial loans. Then there are other institutions that do take in deposits and do make loans, but that demand deposit commercial loans are not their specialty. There are probably 1,200 or so savings and loans, and there are probably, 10,000 credit unions. There are thousands of credit unions. And I'm really not focused on them right now. We'll be talking about banks unless I say credit unions or savings and loans. Okay? There are types of banks, and we'll have three categories here. Money center banks, regional banks, and community banks. So let's just talk about them in that order. Money center banks are huge. That's the number one rule. I don't know if that's number one. That is definitely true. They are huge institutions with assets, sometimes in the trillions of dollars, total assets. Total assets is how much money, what's the dollar value of everything that that bank holds. Hundreds of billions up to trillions of dollars. Well, I shouldn't say trillions, less than two, but more than one. I printed out a chart that I got from the Federal Reserve. Let's see. J.P. Morgan Chase. This is formed by mergers between several institutions. J.P. Morgan Chase. Total assets, $1.7 trillion. Pretty big, huh? Anyway, that would be an example of a money center bank.
How much do they have?
$1.7 trillion. Now, I am not telling you these things so you'll know every possible number. But anyway, domestic assets, $1.1 trillion. And so they have $600 billion in assets overseas. They have foreign branches. Okay, this is a huge institution. Branches in the United States, 3,600. So just scattered around here, there, and elsewhere, 3,600 branches. So anyway, there would be an example. So they're huge. They have many U.S. operations and foreign operations typically. Not every single time. Something that makes these money center banks is that they attract many funds from sources other than depositors. Let me come back over here. I don't want to let on like they don't have deposits, but this specialty I talked about with banks is that they attract a lot of deposits. They do. Money center banks, though, they're different, and we'll get to the community banks later on. Community banks are fairly passive, and I don't mean to say lazy, but for the most part, community banks are sitting back and the dollars are flowing in, you know, and like you get your paycheck and you have it automatically deposited. You maybe take your paycheck to the bank and you put it in. And the banker says, thank you very much, I'll see you, you know, next month. And these money center banks, they are just not waiting for that to happen. Those money center banks, yes, they would love it if you drop some cash off for them. But those money center banks then, they are calling up all around the United States and overseas saying, hey, do you have any money for me? And they are very aggressive in seeking this. And so they have lots of sources of funds that are not deposits. They are just borrowing that money. They borrow the money and then they lend the money. I told you every financial institution, we can draw a little picture like this. Where do they get the money and where do they send the money? And there will be one called a finance company. And what a finance company does is it borrows everything. There's no deposits. A finance company would be an example of what? GMAC that makes loans to people who buy cars. But then there are also just finance companies that, you know, you might see one and say, oh, here's a finance company. And then you go down and just borrow money from them. Where do they get that money? They go out and borrow it. So they borrow it from one group of people and they lend it to another. So what I'm saying to you is money center banks do quite a bit of that. Okay? But they still bring in hundreds of billions of dollars in deposits. It's just that they are more focused on this borrowing than the others because they are more aggressive. They wait, they go out and they get all the deposits they can collect, and then they say, that's not enough. Let's go get another $100 billion. So anyway. And then when they lend, the money center banks, they don't sit back and wait and then somebody comes in and says, could I apply for a loan? The money center banks got salesmen, saleswomen, and they are just going around and making calls on big companies, calls on governmental units, state and local governments, and also governments overseas and companies overseas, and they're going in saying, we want to lend you some money. So they are very aggressive at finding dollars, and then they're very aggressive at putting those dollars to work. And those are money center banks. Okay? Regional banks, and also your textbook uses the term super regional banks. And you know what super regional means is regional big. Okay. I'm not too wild about the super regional term. It's just one of the bigger of the regional banks. Anyway, what regional banks do is this. They are still focused on deposits as their main source of funds, more than the borrowing aspect, like we just described with money center banks. Okay? And then the super regional bank, it is doing business within the United States. Within U.S., focus on deposits as a source of funds. And they tend to be large. Okay? A lot of attention to retail customers. Retail customers like you and me. Now, there really are not people like you and me, but other people just walk in and say, hey, I want to open an account and so forth. And these banks have lots of branches. When I said they're within the United States, a region, or most of the U.S., now, I'm going to give you an example of a regional bank, Bank of America. Bank of America is a huge institution. Let me look at the same table. Bank of America is second largest bank on this same table I cited a moment ago. It's got $1.5 trillion in assets. So if we just went by size, we'd say, gosh, it's as big as money center banks. But the point is this, is that even though it's huge, its business is different. They are not nearly as focused on going out and borrowing that money. They are much more an institution that has branch offices and has a lot of retail customers. Right? And so people come in, they open a checking account. Small businesses come in and borrow some money from Bank of America at the local branch. How many branches do they have? 6,200 branches. Over 6,000 branches. And so Bank of America is an institution that is more of a bank doing business with people and small businesses all around the United States. They're not in every state, but in 40-some states, maybe 42 or something like this. Whereas, J.P. Morgan Chase, it's in many fewer states, many fewer branches, but operations in other countries. Bank of America, really, I don't even know if they have any foreign branches. Let me look. Oh, here we go. 95% of Bank of America's assets are within the United States. Whereas with J.P. Morgan Chase, it was, what, 2/3, wasn't it? 67%? Yeah. Okay. By the way, I mentioned, I'll write a couple of these down here, J.P. Morgan Chase. Another one would be Citibank. Those would be two money center banks that are very well known. What do we have? Citibank has 52% of its assets within the United States. And it is in excess of $1 trillion in assets. Okay? But it has lots and lots of foreign branches. They'll have a branch in London, a branch in Tokyo, and so forth, and many other countries. And then they're doing business overseas with large corporations. Here's a couple more. Wells Fargo and U.S. Bank would be regionals. U.S. Bank Corp. Anyway, those would be regional. And each one of them has 100% of their assets here in the United States. And each one of them is in the hundreds of billions of dollars of asset, but not in the trillions. Okay? What we have here with the money center banks, I'll put a number up here. It kind of depends on how you define things and so forth. But we're talking about 5 banks, 5 or 10. That's kind of on an outer limit. And then with the regional banks, and by the way, these I listed would really be what a super regional, they would be large at the upper end of that. There's a bank much closer to home that would be what? Commerce Bank. And that would be a regional bank. It's got its headquarters in Kansas City. Okay? But anyway, these institutions, regionals, super regionals, we have about 400 of these banks. And they are defined by, as I say, this sort of focus on retail banking and then operations in multiple states throughout a region. Okay? But all of them have assets of greater than $1 billion. These regional banks. If they had assets below $1 billion, we'd put them in this next category of community banks. So I've kind of run out of places to write here. Let's talk about the community banks for a minute. Assets less than $1 billion, and the focus is local, not necessarily just one town, but that town and maybe the surrounding county or metropolitan area, but they don't get very far away. Okay, and they are much more passive. They're doing business with retail customers, and they're much more passive about people making deposits without being encouraged too much and without working too hard at getting them. And then they're much more passive about waiting for somebody to come in and apply for a loan without going out and rattling everybody's cage and saying, would you like to borrow, would you like to borrow? And there are about 7,000 of these banks, more or less. I said commerce, I put it in the regional category. And there are lots of small banks around town that we would put into this community category. See this line right down here? There's where I've connected commerce to those other banks. Anyway. Okay, and as I say, I don't even know. These guys are aggressive, the money center banks, and also the regional banks. I hate to say the community banks are passive, but they are just not as aggressive. They are much more of waiting for the customer to come to them. And they put some ads in newspapers and things like that. I wouldn't want to say they don't. Anyway, questions about this before we go on? Here's the thing. I'll go back to this number, 7,000 or more. Why do we have so many banks? And you might just go, I don't know. Why not? And if you just take our own, throughout my life, throughout your life, there have been thousands and thousands of banks in the United States. But if you compare the United States to the rest of the world, we have a huge number of banks. There are probably in Texas more banks than there are banking companies than there are throughout Europe. Hundreds of banks. This state has, I'm going to say 300 banks, banking companies. Separately chartered, separately licensed banking companies, more than 300 in this state. That's more than most any country in the world. So why do we have so many banks? And the answer is, well, it's just like everything else. There's not a simple answer. There's a complicated answer. Why so many? And I'll say in the USA, because that's where we are. Those of you foreign viewers, we're just focused on the United States now. A lot of this is historic. One is that there was a suspicion of concentrated financial power in the United States. This is historic. It's almost in our genes. It's really not. People in the United States come from everywhere. But this has really been a constant throughout America's history. You know, the people who came to the United States from Europe very often were leaving countries where there was a ruling class, people who just more or less had their way with everybody else. And there was this sort of flight away from that to go for, you know, this land of freedom and land of opportunity and so forth. And so anyway, people leaving these areas where there was concentrated not only financial power, but also political power, and trying to get away from that and just come to this land where each person would go out and have their own little house and manage their own life. And so this was part of the story. And then later on, this really never left, it still exists, but then later on we got this populist movement, in the late 19th century and in the early 20th century. And this became like a political party. So I'm saying what started off as a tendency became a political party, back in late 19th century, like 1890s and so forth. And so there was just this suspicion like, that's bad stuff. Big banking companies, got to do away with them. Okay? And then there's this other tendency that is American in nature, and I'll just use the term federalism. The idea of federalism is this, is that government should be controlled by the people that it is governing. And so, to the extent possible, let's have governance of the people at the local level. And there are some issues that cannot be handled at the local level, so let's have the people being governed at the state level. And then, if there are a few things that people cannot do at either the local level or the state level by, getting together and establishing government and so forth, then we will relegate those other responsibilities to the federal level, the national level. Okay? And so this whole idea of keeping control, government, sort of close at home, what happened was state governments started regulating banks. And so what they would do is they would say something like, a state government, okay, you can open 3 branches or 10 branches or whatever. You can branch into the next county or you can branch statewide, but the whole idea of a national banking company just opening branches everywhere, that would be something that a national government would allow. And historically, we have just not had that in the United States. Historically, there's been this suspicion of a big, strong national government and then some of the things that national governments may allow, such as national banking companies. So anyway, this is just sort of the general tendencies of Americans. Now, a little bit more history that'll kind of get us to this. We had the first Bank of the United States, 1791 through 1811, had a 20-year charter. Okay, so let me back up. We've already got, at this point in 1791, we've already got some banks that are being chartered by states, chartered or licenses from states. And then this bank had a national charter. There's already this suspicion among these people in the United States living in the early states, previously the colonies. There's already this suspicion of big, strong financial power, political power, and so forth. And so in 1791, not long after the country's been in business, the national government issues a charter to this big banking company. All the other banks had state charters. And so what happens? This big banking company, it takes a series of steps. I'm not going to go through all these here, but basically to make life difficult for the state-chartered smaller banks, putting a lot of them out of business, competing with them, and then making loans, or at least this is the charge, making loans to people and companies that are financially or politically connected to the powers that be in Washington, D.C. And so basically just made a whole bunch of people unhappy. And then a political movement got started over this, and when its initial charter of 20 years was up, it was so unpopular that the government did not issue another charter. And out of business it went, only to be replaced 5 years later by, that's what I'm going to tell you next time. I'll just keep you hanging on the edge of your seat. So long, I'll see you next time.